Right guys, beginning of macro week, we're going to cover central banks. Why? Central banks are the entity that have the biggest individual impact on macro narrative, on macroeconomics. Now, macro stuff is not all about a central bank. Macro stuff is generally the sort of wider how the economy works, why people spend money where they do, how supply and demand intersect and change, how unemployment differs, demographics, all of those things factor into the kind of macroeconomic landscape. But the only entity that has a really, really strong individual impact is the central bank. Why? Because central bank controls the supply of money and the price of money. That's the two key things that a central bank does. By doing that, they can influence macro trends and impact how the economy shifts over time. So what we're going to look at is how a central bank operates. Not just they rise and drop interest rates, which is the one thing everyone knows, but what else do they do? How do they do it? And how do these things then transmit into the wider economy? Because that's the key bit to it. And if you're going to trade a central bank, and we'll look at central bank prep in a little while, if you're trading a central bank, it's less about the obvious rates have gone up, therefore this should happen. The action's happened by that point. The information's gone. It's about the understanding of when rates are going to rise, why they might fall, and how to understand the impact that that is then going to have. So to do that, we need to understand how they actually operate, what they actually do. So a little bit detailed, quite dense in terms of knowledge and information. I will try and make this realistic, related to how things go on for each of us personally, because the way that you transact with your bank is the way that a central bank transacts with a commercial bank. So it's all just part of the line, it's part of the chain of how money moves. So let's start off with, what's the role of a central bank? Now, this is not in order of priority, but one of the important things that a central bank does is they print money. Now, this is not all in the case of cash that we see, the paper notes that probably got one in my pocket, or plastic notes as they are now. They do that. But this has no intrinsic value. The paper, the plastic, whatever it's printed on is worth very, very, very little. So the money is actually not worth anything. They also can create reserves. This is not physical money. This is essentially computer generated, if you will. And that's another version of printing money. You essentially can just put another zero on the end of a bank balance and that creates 10x that amount of money. The central bank can also destroy money. They can create it and they can destroy it. And so by influencing the supply of money, you impact on the cost of money, the value of money. If a central bank goes wild and prints money, there's loads of money everywhere. The value of that decreases. Essentially, this creates inflation because your £10 will now not buy the same if there's loads more money around, because in simple terms, if I as a shop owner know that everybody's now got loads of money, stuff that I was selling for 10, I'm now going to sell for 20. And if people still keep getting loads of money, I'll sell it for 50 and 100 and so on and so on. So that's how printing money too much can create inflation. Likewise, a central bank can essentially destroy money. They don't physically have a big bonfire and they throw the notes on it, but they can take money out of the economy. Essentially, they can just cut it off of balances. That way, you reduce the money in the economy, and by doing that, then you restrict the amount of money available. This restricts people's ability to spend. Right, so that's one way that they deal with stuff. The other thing is they can put or set the cost of money. This is the interest rate. Now, as I'm sure most people are going to be aware of, the interest rate in whatever country you are set by the central bank is not the interest rate that you personally pay. The interest rate that you pay on a loan, on a credit card, on a mortgage varies based on your own credit. The trustworthiness that a bank, or the trust that a bank has in your ability to repay something, and also whether it is collateralized. So if something is called collateralized, this would be akin to, say, a mortgage, whereby if you don't pay, the bank has a claim on your house. They can take your house to pay the money back, to get their money back. That would be a collateralized loan. A collateralized loan generally is at a lower interest rate because there is a security. The bank knows they can take your house. An uncollateralized loan or an unsecured loan is one where it is a straight loan, something like a credit card. The bank will allow you to spend up to 2,000, 5,000, 50,000, whatever the amount of money is, and they have no recourse. If you don't pay, they can't take anything from you without legal proceedings. So that's unsecured. There is nothing, and so therefore you will pay a higher rate of interest because they're mitigating the fact that you may not pay, you may default. And if you do default, you may not have anything to pay them back with. That's the difference between secured and unsecured lending. Now, that all comes back to interest rates, the cost of money. The central bank sets the rate of money on a very short term. Commercial banks borrow and lend money with each other on a very short term, and they then pass these costs on to consumers in the form of, one, cost of loans, but they also pass some of that money on in the form of interest on deposits. If you hold some money in your bank, you get some interest on it. And so that's the other way that interest rates get transferred into the wider economy. Central banks will also manage reserves. Now, back in the day, if I can use that phrase, a lot of currencies were based or backed by gold, i.e., you could only print as much money as the reserves of gold that you have, or a multiple of that. Now, the problem with that is there is only a finite amount of gold in the entire world. And so therefore, there would only ever be a finite amount of money, which creates a little bit of an issue. This is the difference between paper money and coins as well. Coins had an intrinsic value. Again, back in the day, many coins were actually made of gold. And so the intrinsic value was the weight of the coin. And so that was the value of the money. Whereas now we have what you call fiat currency that is based on trust. If that note that I was just holding up says £10 on it, there is a trust within the wider economy that everybody else will be willing to exchange that £10 note for another £10 note, and they have the same value. There's no intrinsic value in the actual note itself, if you broke it down. So the value is there, created by the idea of a creditworthy central bank. But they will manage currency reserves as well. A central bank will have reserves of multiple currencies. If you're in the UK, the Bank of England will have euros and dollars and Aussie dollars and yen and pesos and all sorts of other currency. Because there will be a time where a commercial bank may need some more dollars. Say, for example, I'm going to America. I go to my bank and I say, I need to swap £5,000 into dollars. Can you give me some dollars? They can give me some dollars, but now they've got a deficit of dollars. They go to the central bank and borrow some dollars to refill that gap. So central banks will maintain reserves of foreign currency. They will also hold bonds, high quality assets. Many of these bonds are held because a commercial bank will have gone to the central bank and said, we need some cash, here's some bonds, give us some cash. That's what's called a repo. We'll get to that in a little bit. That way, the central bank will hold a large number of bonds as well, high quality collateral. So they will manage those reserves. A central bank is also a lender of last resort. What this means is that if a bank gets in trouble, can't borrow money for whatever reason, then the central bank will step in. So the situation would be, and we saw this with things like Lehman Brothers and other banks before Lehman Brothers went bust. We saw it quite a lot in the financial crisis, that if a bank couldn't borrow from any other banks because they don't believe that that bank will be able to pay them back, then they can go to the central bank. And they say to the central bank, look, none of these guys will lend me any money. Can you lend me some money? The central bank will, at a slightly higher rate than they would normally lend money, and against collateral. So the bank who needs the money provides some bonds, the central bank will give them some money, they will then pay it back, and this effectively can restore their credibility. People will then like, okay, they will pay back, they're still good, it's all good. So that's the idea there. This is to avert a credit crunch. If all banks don't want to lend to each other, money stops flowing around the economy, and if money stops flowing around the economy, the ability for me to borrow some money goes down as well. So my spending goes down along with everybody else's, and that's where you get credit crunch. The spending gets constricted because no one trusts anybody else to pay them back. So that's the problem. That's where a central bank will step in. They're also the bank of banks. Yeah, they are the banker to the banks. In the same way that if you and I have a current account at your bank, the commercial bank has a current account at the central bank. And so in the same way, they will pay money out. If I take a loan out, my bank will give me some money. They will then need some deposits coming in to counter that. In the same way that you theoretically have to keep a positive balance in your bank. I'm not going to go into overdraft details like that, but that's the whole idea. Central banks will hold an account at commercial banks will hold an account there. Governments will also hold an account at the central bank. Just to point one thing out, there is independence between a government and a central bank. There wasn't previously until really about the 80s and 90s. The idea here being that you need independence because otherwise, when a government wants to borrow money, if they also control the central bank, they control the price of the money. So you'd then be in a situation where the person wanting to borrow money is also the person who decides how much and at what cost. Now, put that into your own terms, if you were wanting to borrow money and you could tell yourself how much to borrow and how much to pay on it, guess what? I would be paying 0% interest on anything I borrowed because it would be me setting the interest rate. That's not viable. So there needs to be independence between the two, but a government will still hold an account at a central bank. The other aspect, which is less important to what we're looking at, because we're looking at how this impacts trading, what it impacts, is that a central bank supervises commercial banks. There are other aspects to this, regulatory stuff, Securities and Exchange Commission, the FCA, FSA in the UK, all of those kind of things. This is not really the area that we're massively interested in. What we're really interested in for today is this and this. They're the two things that will consistently move. These are lender of last resort, for example, is something that may happen in an extreme circumstance, and we'll talk about this when we get to crisis later on this week. But for now, we're looking at the general function of a central bank, what they do and why they do what they do. Right, so let's move on. Printing of money and interest rates are part of monetary policy. Now, I'm sure some of you guys know a fair bit about this, but let's try and break it down into simple terms in terms of what matters. Right, if you are trading any central bank information, you need to understand monetary policy and what is going to cause a central bank to change their current policy. And this all comes down to, generally, maintaining price stability. That would be your catch-all. If someone said, what's monetary policy all about? Maintaining price stability. Now, to do that, as I said, they can increase, decrease the supply of money, increase, decrease the interest rate. Their policy can shift from expansionary to contractionary or the other way. Expansionary policy, things are made cheaper, it's easier to borrow money. The idea behind this is then this allows people to borrow money, spend money quicker, and also disincentivize savings. So if interest rates fall, my savings earn me nothing, I might as well invest that in something. Start a business maybe, invest it in other assets, which will then benefit other people to improve their businesses, etc., etc. In a contractionary monetary policy, the idea is essentially to restrict money, restrict the supply and increase the cost of it. By doing this, I have less ability to borrow money because money is now more expensive, which disincentivizes spending. And people will think twice about buying a new car if interest rates are rising because they know that they're going to have to pay a higher rate if they get a loan for a car, for example. Equally, it incentivizes you to save. If I know interest rates are rising, put more money into savings, that takes away general spending, which slows down growth within the economy, slows down inflation, and also I get a benefit from it, I get more return on my money. Each individual central bank has their own variation of price stability and they will have a mandate. Now, the mandate is what is going to influence the changes in monetary policy, so you need to understand what this is. Look on each central bank's website, you can find out what their mandate is. It's not always clear, it doesn't say mandate is X, but you need to understand what it is that impacts their monetary policy. If you Google it, generally you'll be able to find a rough explanation of it, but it will come down to the tools that impact their monetary policy decisions. It will generally roughly be written within their statements as well that you will see at a central bank meeting, which we'll come and explain in the next session. So let's take the Fed, US Central Bank. They have a dual mandate. A dual mandate includes maximum employment and inflation that averages 2%. These are key aspects. Averaging 2% means that it can go above or below 2% as long as, over time, it averages out at 2%. They also have maximum employment. Now, maximum employment is intentionally vague. What maximum employment does not mean is zero unemployment. Zero unemployment is not necessarily a good thing because what zero unemployment does is it raises wages, which increases inflation. I'll give you an example. If you've got zero employment and thereby everybody has a job, if somebody goes to change job and everybody else is employed, this one person can demand whatever they want in wages because they are the only option. As a company, you have to take on this person if you have a new job role because there's nobody else available. So this person can be rubbish at the job, but you're going to have to pay them whatever they ask for because there is no alternative. What this does is this now sets the bar for higher wages. Other people may now change jobs and ask for the same, and so on and so forth. So this ramps wages up. So zero unemployment is not necessarily a good thing. You need a degree of unemployment to create competition within the workforce, meaning that then if you have 2% unemployment, you can then have a situation where you get 5 times the number of people going for a job. Now wages don't have to rise as much because there's competition. You can employ the best person and know that you don't have to pay them whatever they ask, because if they ask too much, you can employ the second best person for less. That's the simple basis behind it. So maximum employment, generally, and looking at the way the Fed has acted over recent years, it would be fair to assume that maximum employment is somewhere between 3 to 5% unemployment. That gives sufficient what you would call slack in the labour market, the ability of people to move without impacting on inflation. So that's the Fed. Now the ECB has a price stability mandate. They just go straight for what is monetary policy? Well, our monetary policy is price stability, or your mandate is price stability. But this is then clarified into inflation at 2% over the medium term, and that the price target is symmetric. So they don't have unemployment or any of these other things. Inflation is the key. Now, what they mean by symmetric is that if there's your 2% inflation, if inflation goes above, they will do something about it. The implication is they will raise interest rates if inflation goes above 2%. Equally, if inflation goes below, they will do something about it. But they are willing to accept that this is over the medium term, and so there will be periods where inflation remains above 2%. As long as it is not continually rising above 2%, like that, they're happy. And they will act to bring it back. So essentially, what they're saying is inflation above or below 2% is not good, and we will do something to push it back. This is a change from what their goal used to be, and for what other central banks have a goal of, which is where they have a 2% target, and the ECB used to have a 2%, a close to but below 2% target. I.e., inflation down here is not that much of a problem. Inflation coming up here, they will act. Inflation rising further, they will continue to act to try and push it down. So essentially what they're doing is they're promoting a situation where low inflation is not overly bad, which can then, through expectations, maintain low inflation. This explains why the ECB, in the summer of 2008, in the summer of 2011, raised interest rates, despite the general consensus that you had an impending global crisis. Interest rates do not need to go up in that situation, and look at what the Fed did at that point. And you had a European debt crisis. European countries needed money, they needed cheaper rates, not higher rates. But because they have a single price stability mandate, and because at the time it was not symmetric, interest rates were raised into a crisis. Not ideal. The other thing you hear about with monetary policy is transmission of monetary policy. Now, what transmission of policy is about is communication and expectations. It's all well and good changing these rates and changing the amount of money out there. But if people don't believe the ongoing impact of it, then it doesn't have a great deal of use. So that's the transmission. How does a change in interest rates, expansionary or contractionary policy, actually get transmitted into the wider economy? So this is from the Fed website. That's their goal: maximum employment, low stable inflation. Monetary policy. This is your target for the Fed funds rate, and also communications. We'll come on to this in a little bit. Transmission channels. This is how monetary policy gets enacted via interest rates, asset prices, exchange rates. So the central bank changes the interest rates, but this has an impact on financial conditions, asset prices and exchange rates. And also, this is important, expectations for households and businesses. The idea here and the goal here is to manage expectations of what's coming. The idea then is that by managing these things, you create the desired effects. Now, on the expectation side, what they're trying to do is create a sense that interest rates are going to keep rising. By doing this, as an individual, if I think interest rates are going to do this, then I'm going to slow down my spending because I know that things are going to get more expensive. Thereby, my slowing down in spending and other people slowing down in spending reduces inflation, because you don't have this propensity to buy because you're now incentivized to save, and you know that things are going to get more and more expensive. You want to hold on to your money. So creating the expectation of rate rises to combat inflation prevents people spending money, which thereby reduces inflation. Now, if you don't create that expectation, then you have a problem where people expect prices to rise. They will spend money now, because if they don't spend it now, they know they're going to have to pay more in the future. So that's the idea of the expectation side of monetary policy. It's about making sure that people's expectations of inflation and interest rates are aligned, and so therefore they don't get over the top, because it's inflation, it's expectation that breeds inflation. Right, so let's have a look at policy, interest rates versus inflation. What we're going to look at to start with, why does inflation rise? We use inflation rising because generally interest rates don't necessarily drop on inflation falling. They usually drop as a result of another factor which generally causes inflation to fall. So it's less chicken and egg, I guess would be a way of trying to put it. So why is inflation rise? You have two types of inflation, cost push and demand pull. Cost push inflation is where external factors increase inflation. This is the post-pandemic situation where supply chains, the ability to get the goods is not there. So if you need goods now, you have to pay a higher price because the transportation of goods has gone up. Energy costs have gone up, let alone the price of the goods that in many cases have gone up. So these are all external factors. It's not the fact that there's a sudden mass demand to buy things, which was the original expectation post-pandemic, and that was true to a degree. But it's the fact that there are less of those things because people are producing less of them, and there is less ability to get hold of those things because costs of transportation have gone up, or there are less people to actually do the transportation. These things push inflation up. This is difficult to control because restricting people's ability to spend doesn't change the fact that the reason prices have gone up is not because people are spending more money. It's because of the fact that these things are less easy to get. So supply of them goes down. If you want it, you have to pay higher prices, not because you want to pay higher prices. No one really wants to pay higher prices, but demand pull inflation is the opposite. It's not necessarily people wanting to pay higher prices, but people willing to. If you have a growing economy, people generally have more cash. As people have more cash, they spend more money. As a business, their prices will then rise. As prices then rise, customers spend more money, but customers now also demand higher wages, which perpetuates the rise in inflation. This is more traditionally easy to deal with because if you raise interest rates, this curtails people's willingness to spend and stops prices rising so quickly, which reduces wage demands, which slows inflation down. That's a little bit easier to deal with. The cost push is harder. Nevertheless, interest rates will generally rise in whichever circumstance, because whilst cost push inflation is external, the impacts can then create inflation on top. So if, for example, you have prices rising, you then get demand for wage rises, which is what you're seeing in the UK in 2022 with strikes, etc. People want more wages. Now, the difficulty with this is that higher wages will mean that if inflation does start to fall, it will then not fall all the way back because as it drops, the higher wages give people excess cash when prices fall, meaning that they will then spend money, which pushes prices back up. So the goal of a central bank is to steadily increase interest rates. The idea there being that if you raise interest rates at the right pace, what you do is you hold inflation back. Quite simply because this changes spending and borrowing habits. Higher rates, savings more attractive, borrowing and spending is more costly, so this lowers inflation. You take money you take money away from inflation because either you stop people borrowing money or you increase the amount of money that they don't spend and put into savings. Conversely, lower rates, borrowing is cheaper, so you can borrow some money nice and cheap and go spend it, and also your returns on savings are very small. So if you're not getting a return, people are incentivized to go and spend. This pushes inflation. This allows the economy to grow because if I go and spend money somewhere, that shop gets more money, they can employ more people, they can then start moving into other areas, they expand, that creates more jobs, more productivity, the economy grows, theoretically, not just because I spent money, so many people have spent money. So, the dangers of monetary policy, interest rates, inflation, GDP, stagflation. This was a buzzword, particularly through 2021 and 2022 to a degree. That what you have is rising costs, particularly with cost push inflation, rising costs on inputs, which damages companies' profit margin, what they buy to produce what they produce, it goes up, profit margin gets smaller, and labour costs rise. Again, costs rise further for a business, profit margins get smaller. The problem there is if that perpetuates, some businesses will fail. That's the harshness of rising inflation, because one way to get inflation down is higher inflation, because inflation will only go up to a point before it gets businesses to fold faster and faster and faster. Unemployment goes up, and so therefore there are less people able to spend money because they literally have no money, and so therefore inflation drops rapidly. The problem with that is now you have a new issue of a recession or potentially even a depression, where now you've got to try and get businesses back up and running to re-employ people to get spending going again. So you can end up moving from one extreme to the other. High inflation will almost inevitably create a recession. It's just whether it does it naturally or whether the recession comes from raising interest rates. Because rising interest rates when inflation is high has the impact of increasing costs when costs are already increasing. The only real way to cope with high inflation and it not create a recession is increased productivity. If you go and watch the YouTube video by Ray Dalio called How the Economic Machine Works, he explains this very well. I can send you a link to that as well. This is fantastic. Creating new products or more efficiency means that if your profit margins have been squeezed and you can create a new product, or you can increase the amount of product you sell with the small profit margin, you can keep the same number of staff but increase your overall profit. Thereby, you are more productive, you can afford the wage increases, but you're also supplying more stuff, which does then mean that you can expand and produce more jobs as well. This then allows inflation to be mitigated because productivity keeps pace with inflation, meaning that inflation in relative terms reduces. That's the only real way to deal with it. Now, the balancing act that a central bank has to deal with is if you increase rates too fast, you create a recession by making things too expensive at a point when people already can't afford them. If, however, you increase rates too slowly, you run the risk of inflation getting out of hand, growth falling, unemployment rising, and you get stagflation. This then is a problem. So, the central bank needs to try and deal with this situation and create what they will call a soft landing. A soft landing is a situation where growth does not fall too far and potentially doesn't even quite go negative. Maybe it falls from 3% to 0.2%. And inflation gets pulled back down. So yes, things will get worse relative to what they have been, but they won't get really, really bad. The economy is still growing, it's just not really growing at any pace, but that's better than the economy completely contracting. Now, the difficulty is, if inflation is left to it, this is almost inevitably going into a recession. But if rates are raised too quickly, then what happens is, yes, inflation will come down, but inflation will drop because you create unemployment. So you create the situation that would happen anyway if you raise rates too quickly. That's the fine balancing act that a central bank has to try and deal with. If they get it right, you have a situation where inflation does start to drop, interest rates will stay high for a period, and then growth will come back. People are able to afford the higher interest rates because inflation is not so rampant anymore, and eventually growth will come back, meaning that higher costs generally are more accepted because of the fact that people are earning more money and the productivity comes back into the economy. That's the ideal Goldilocks scenario. It's a very difficult tightrope to walk. Think of it like, if you remember the old school computer game of the helicopter that goes through a kind of channel of cliffs and mountains. You have to press the button to give the helicopter a boost to go over a little mountain. Now, if you press it too hard, raise interest rates too fast, you hit the ceiling and you crash. Equally, if you press it too soft and raise interest rates too slowly, you hit the mountain. So it's about creating that fine balance of going just far enough, but without overcooking it. That's essentially what the central bank's trying to play with interest rates. So let's go and have a look at interest rates and inflation. This is what we've seen over about the last 20 years. 2005 to 2007. What we had here is what you would call restrictive monetary policy. So contractionary, and then the extension of that is restrictive policy. What's happening is inflation rates are above 2%. So inflation's sitting above 2%. Interest rates rise, and look how rapidly they rise because inflation is not coming down. So this is essentially a central bank continuing to raise interest rates to hold inflation back, basically. It's like a dog trying to run away. You have to increase the amount of, or a tug of war, you have to keep on pulling to make sure that it doesn't run away from you. So the central bank has to keep on raising rates quickly. In this situation, they raised rates 14 months in a row, and they raised 25 basis points, 7 months. For anyone who knows a bit about central banks, currently a central bank has a policy meeting around about every 6 weeks, so 8 meetings a year. Early 2000s, they would have one every month. Don't rule out the possibility that that could ever happen again. Just something I always try to think in alternatives and other things that could happen. But this is what you call restrictive policy. They're trying to restrict inflation as it is getting above 2%. 2016 to 18 then, we have a much slower growth in interest rates and to a much lower rate. This is post the financial crisis where rates stayed very low for 5-6 years and then steadily started to rise. Now, this is what you would call accommodative. There's your 2% line, and inflation pivots around this zone. Now, what they're doing here is raising rates to preempt rising inflation and thereby keep it on an even keel. At this point, the economy has been growing since the financial crisis. Unemployment is back down to around 4%, historical low levels, 3.5% I think it reached in the US. Growth is coming back, equity markets are doing well, generally the economy is doing well. So, to prevent inflation getting out of hand, because when things are going well, people are more keen to spend money, prevent it getting out of hand, particularly with rates very low, they then steadily start to raise interest rates to deal with inflation at 2%. Now note, interest rate rises are often somewhat preemptive and are there to kind of hold back inflation. Interest rates cuts, generally much more dramatic, and are much more there to deal with a problem. So interest rate cuts are often slightly more reactive to a situation. Interest rate rises typically are more in line with trying to mitigate a situation happening before it gets bad. What we've had post-pandemic is very quick raises of interest rates because of the speed with which inflation has come round. So it's been a little bit more of a dramatic raise in interest rates, I think historically very, very fast. This is the issue with cost push inflation. It is more akin to the 1970s if anyone wants to go back to that period of time. Right, let's go and have a little look at the impact that this has on different assets, starting with bonds and understanding where you need to be looking if rates start to rise. So what we've got here then is the period from the beginning of 2021 to the end of 2022 and what happens with Fed interest rates, so that's the target rate, 2-year bonds, purple, and 10-year bonds, green. What you need to be focusing on here is the difference between each of the rates. They're all displayed on the same scale, so this is all exactly the same scale. And what happens then is, as expectations change and as rate hikes start, you see different things coming through. So if we look at the beginning of 2021, what you had was a situation where 10-year rates rose. Remember, this is rates, so this is yield on a bond, this is bond prices falling. 10-year bonds are falling, 2-year bonds are not doing a great deal, and Fed rates are doing not a great deal. So you get to a situation where a 2-year bond yields around about 0.25%, and a 10-year bond yields around about 1.9%. This is what you would call a steep or steepening curve. It's gone from a difference of about 1% to now a difference of around about 1.6%. So when you talk about yield curve, and we'll talk about this with a little bit of correlation, you will have a yield curve that will look like this. This will go from 1 month all the way through the years up to, say, a 30-year bond. That's a steep yield curve. That is a reasonably good thing. For a bank, that's a good thing because they can borrow money short and lend it long, is the basic way that bank works. They will borrow money down here. They will lend it to you on a mortgage for 30 years up here. They make the difference between the two. And what they do is they keep rolling this borrowing over because they have to pay that money back. Then they reborrow at low rate. They still lend the money to you. You now pay it back at a higher rate. They make the difference. So essentially, that's basically how a bank makes their money. So they keep rolling over short-term debt and making the difference between the rate that they pay on short-term debt and the rate they receive from you on longer-term debt. What then starts to happen is we start to get the first talk of stagflation. Inflation does rise at the beginning of 2021, and most people expect this. Remember, we're coming out of the pandemic. People have got lots of money saved up because you couldn't spend during the pandemic. The expectation is everyone's going to come out and start spending. And that was the case. Inflation started to rise. And this was expected, but expected to be, as they called it at the time, transitory. Inflation is going to fall back down. Inflation didn't. So then you start to get talk of stagflation and the necessity for the Fed to raise rates. The first talk of that happens down here, and you start to see the 2-year bond rising. The 10-year bond falls. Now, the reason that the yield on 10 years fall is that if you're going to have a potential recession, you've got to think about what people are buying 10-year bonds for and the alternatives. With 10-year rates falling, this is people buying 10-year bonds. Now, the alternative place to put your money is maybe stocks. But if you expect a recession, you're now going to look at this and think, well, if a recession's coming, actually, I'm better off to buy 10-year bonds and sell stocks. So you get this asset switch, which is why then the curve gets what you would call flatter. We have gone from 0.25 to 1.9, so 1.65 difference between the two, to now a situation around here where we're up to 0.3 to 1.2. So 0.3, 1.2, you've now got a difference of 0.9. So the curve will have gone from that to that. That's showing a slowdown, essentially. That would be the way to read the curve there. The curve flattening is an indication of slowdown. Now, as you go through 2021, the sense becomes clear that the Fed is going to start raising rates soon. Expectations. Once it becomes clear the Fed's going to start raising rates, bond yields rise on a 10-year. Bond yields rise much more dramatically on a 2-year. And as they start 2022, 2-year bond yields rise very quick. Expectation is rate hikes are coming soon. So with that in mind, the 10-year yields don't really rise. Over the course of the back end of 21 and the first quarter of 22, 10-year bond yields rise 0.2. 2-year bond yields rise from 0.5 to 1.6. They rise by 1.1. The curve now is virtually flat. The difference between the two is about 0.2. So you've gone from 1.6, curve that looks like that, to now a curve that looks much more like that. Flattening curve is an indication of a recession in general. Once rates start rising, we now have a situation where 10-year bonds yields rise because rates are rising. That makes sense. Bond yields will generally rise in a rate hiking cycle, but it's the difference between the two that matters. We then get to a point where the curve gets completely flat. Once inflation peaks in June, rate hikes are starting to get bigger. They go from 25 to 50 to 75. Rate hikes are getting faster. So shorter end bonds, because they're more impacted by interest rates than inflation, rise faster. We now have a situation where, relative to the short end, people are buying 10-year bonds. They're not outright pushing price up that much. Price will have still fallen from where it was over here. Think of this being flipped over. Price will still be down from where it was, but relatively, given a choice, people will buy 10 years and sell 2 years, which is why you then get an inverted curve. And this then goes on. The inverted curve is pricing in a recession. That's what it's essentially telling you now, that with the difference being not far off 2%, or at an extreme having reached nearly 2%, when you got down here, the extreme being nearly 2%, we then have a situation where that is very much reaching the peak, and that predicts a recession. Now, you have to take this, and what you've got to think is it's easy to go, oh yeah, look, well, there was talk of recession was coming, and curve inverts. You have to think what this means. So, if you've got a yield curve that looks like that, it's inverted, let's say that's a 2-year yield and that's a 10-year yield, and that's the rest of the curve. How does this change? Well, there's two ways that it can change. The economy can improve. If the economy improves, people will sell their 10-year bonds and buy equities because things are getting better. People want to take more risk, so the curve will then move to something that looks like that. That's the ideal. That's your soft landing. Great. Alternatively, if things do not improve, then you need action to make things improve. This would be a situation where interest rates get cut. If that happens, the short end falls. Short end goes down, and you get a curve that then looks like that, and they can keep on falling to get a curve that looks like that. That would be your alternative. This is what happened throughout 2019. The interest rates in the short end would drop to deal with an inverted curve, a predictor of a recession, and that then created a curve to re-steepen. So that's what you end up with, and that's what would be expected. Now, that one of those two scenarios is going to be coming out throughout 2023, and it's then your job throughout 2023 to assess the impact of that. and how things are going to change. So it's all well and good to talk about why these things have happened. You then got to think about the implications going forward. Either the economy improves and the curve re-steepens because of improvement in the economy and people are able to absorb the higher cost of higher rates, or the economy doesn't improve and rates have to get cut to enable people to afford these things and enable the economy to grow. This is the impact of those same rate rises on asset prices. So this is asset prices throughout 2022. So what you've got here, asset price wise, you've got the green line is the dollar index. You've got the orange line is gold, and you've got the yellow line is the S&P. What you have here then, inflation rising, potential of recession, rising costs, equity markets from the beginning of the year to the end of the year fall. They fall rather dramatically as well when you have the peak in core inflation, when you have the peak of the acceleration of rate hikes. And this is a really important thing. Markets look forward. So what's going on here? Well, what's happened over here, this is where inflation peaks, headline inflation. Headline inflation includes food and energy costs. They're generally more volatile. Core inflation takes those out. So core inflation is the cost of stuff that is probably more impacted by demand than supply. The headline inflation is a supply issue that we know about. Supply chain issues, energy costs, food costs, all of those things. Now, core inflation gets rid of those parts of inflation. If core inflation still goes up, then that's suggesting that people are still spending money on clothing, on entertainment, on all of those other aspects, which is pushing inflation. So for a central bank to stop raising rates, they also need core inflation to start to drop as well. Now what happens here is the expected pace of rate hikes from the Fed changes. They have gone from 25, 50, 75, 75, 75, 75, and the next hike was 50, and then 25. As the expectations of hikes slow down, then the change comes. The dollar rises as rate hikes go up and rate hikes pick up because the Fed is the one that's raising rates fastest. So people want to put their money into dollars because you get a good return on dollars, dollar strength. But once the expectation is the rate of change is going to shift, the dollar weakens because now the expectation is the pace of rate hikes is going to be outstripped by places like Europe. So then you get this switch that people now start selling the dollar. The dollar's basically done what they've wanted it to do. The dollar has appreciated and they've also picked up increasing interest rate on their money all the way through. At this point, when the pace of hikes slows, this is indicating that you're reaching the peak, i.e. that things are now probably going to get better from here. At that point, gold, which trades the opposite to the dollar strength impacts the price of gold. So whilst inflation is rising, the argument for inflation here doesn't stack up. Inflation rampant, peak inflation, and gold has done that. Peak core inflation, and gold is now down. So the argument for gold to go up on inflation is not necessarily there. Gold perhaps is maybe a better predictor of inflation than it is necessarily a hedge against inflation. But nevertheless, once you get to this point and the expectation of rate hikes slowing down comes, this way expectations matter, then stocks start to rise again. Gold starts to rise again. Because this is creating then the expectation that you can now go and spend money again because the acceleration of costs is going to slow down. Costs are still higher, borrowing costs are still higher, but they're not then reaching the point that people may well have been expecting, or at least they're not expected to keep rising as fast as some people may have thought. That's what's important. So that's why you then get this shift, and that's how hiking cycles can impact asset prices. Think about the yield curve impact on this as well. Right then. So how do they go about managing all of these things? Interest rates. Banks will have more than just one interest rate. I'm going to use the ECB because they have a simplified variation of this. But in essence, what you have is a refinancing rate. This is the main rate that gets quoted. Now, this is the amount of money that a central bank will charge a commercial bank to borrow from it. So like if you or I moved into our overdraft, the amount that you pay interest on your overdraft. This rate then gets passed on to consumers in the form of loans. But consumer loans are generally priced slightly more against longer term bond rates. This is like I was saying, how a central bank will make how a commercial bank makes their money. If 10-year bond yields are very high and I want to take out a 10-year loan, it will be priced against that, not against the current refinancing rate. This essentially sets a ceiling, and I'll show you this on the next graph. If, let's say, the refinancing rate is 1%, that's how much you can borrow money from the central bank. That's the rate you pay at a central bank. Now, a commercial bank doesn't have to borrow from the central bank. They could borrow from another bank. Because if you borrow from another bank, this is unsecured lending. So this is just like asking your mate to lend you 100 quid. You're not going to give them your watch or your car keys as collateral for that. You just trust that, they trust that you'll pay it back. Now, the central bank asks for collateral. So if you're going to borrow money from anywhere, that sets the ceiling because you have to hand over collateral. So this will keep the rate from within interbank lending, so bank-to-bank lending, at a maximum of 1%. There's no incentive to borrow from a commercial bank at a higher rate than that because you could just go to the central bank and borrow at 1%. So that creates a ceiling for lending. You then have a deposit rate, or some may call this a bank rate. This is what's paid on deposits, in the same way that if you hold deposits in your current account, you get some interest. Marginal, but you will get some interest on it. This creates a band then, because the idea here then is you're not going to borrow money above the refinancing rate, and you won't lend money below the deposit rate. If you as a bank have taken on massive deposits that day, so you've got excess cash, that's doing very little. So you can either leave this at the central bank and receive deposit rate, or you can lend it to another bank. But you're not going to lend it to another bank, remember, unsecuritized or unsecured, thereby they don't give you anything in exchange. You won't lend it for less than this. So let's say in an extreme, this is 1%, this is 0.5%, sorry, that's not very extreme. You will not borrow money for more than 1% because you could go to the central bank, and you'll not lend money for less than 0.5% because, again, you could just leave it in the current account at the central bank. The final thing you have is a marginal lending rate, a discount rate. This is a punitive rate, i.e., if you go cap in hand to the central bank and say, please give me some money, I'm low, credit issues, blah, 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 they'll go, okay, yes, you can have some money, but that's 1.5%. So they would be typically the kind of differences between the rates. There's usually somewhere around a 0.5% difference across the board. Maybe it's slightly smaller, slightly higher, but that's roughly how it works. So let's give an example of this. This uses an ECB example. So what you have here is you have the interbank rate, EONIA in this case. What this shows is the rate that banks will borrow and lend from each other, to and from each other. So this is a floating rate. This can be negotiated. If I'm a bank with excess cash and another bank says, can we borrow some money? I'll say, yeah, this is the rate. Knowing that I can't really go above the refinancing rate because the other bank will just turn around and go, no thanks, I'll just go to the central bank. But I can maximize that and say, well, the rate is here, slightly lower. But borrowing and lending interbank is also impacted by the amount of money out there. If I as a bank have excess cash and all the other banks have excess cash, I can't lend at this rate because the other bank that wants to borrow money from me is going to go, well, I'll just go over there and borrow at this rate. So the more cash that's around, the more the interbank rate will deviate towards the deposit rate. But no one's going to borrow or lend either side of this because if you wanted to borrow money, go to the central bank, and if you've got spare money, put it in the central bank. So the interbank rate stays within those boundaries.